ran the Europeg, right, for 3 years, and then the Europeg was a disaster, and then they took that extra capital that they printed, and then they went and created a stock hedge fund with the central bank. It was buying gold mining shares in Apple stock. I think they were at one point when they were the largest shareholder of Facebook or whatever it's called now, Meta.
Yeah, they pretty much recreated the S&P 500. So if you look at their list of holdings, it's all like the U.S. large cap, and it goes down the list from there. They kind of buy things, in order of their market cap, more or less. So they end up owning a little piece of everything. As they've effectively become one of the biggest hedge funds in the world. If you look at their 13F filing, and so that's an example where it already happens in some of these countries. But yeah, you can have it for a very different reason if a number of countries are finding themselves selling U.S. Treasuries and coming to U.S. and say, look, you can either buy some of our debts, we can buy some of yours, or I don't know, like figure it out. So you certainly could have kind of these weird accords where you have more global interaction around some of their debt markets. But that's only, like I said, there's multiple tools. They can do SLR changes. They could just outright go back to QE again, kind of like what you're seeing in Japan with yield curve control, in Europe with basically they're increasingly doing formalized spread control, where they don't want Italian debt to get too much higher yielding than German debt, for example. And so you have most of the major developed market central banks are in a tight spot with how much sovereign debt they have, and that they due to how high inflation is, they can't let those bonds kind of settle at a market rate, and so they're basically finding different ways to suppress those yields below the inflation rate, so that those debts can be inflated away, and so that those countries don't have a fiscal spiral.
This is giving me a migraine listening to all the rules changes. You naming them off, and there's even more coming, unfortunately.
Yeah, there can be ones I didn't think of. Like there's all sorts of different levers they can pull when things get messy, and they're basically ways of disguising monetization of government debt, without necessarily calling it that. And so during the 1940s, for example, I often like to use that example where the Federal Reserve did yield curve control. So, inflation averaged about 6% during that decade, from the early 40s to the early 50s. It got as high as 19% year over year at one point. And they had held short-term rates at almost zero, and they capped long duration treasuries at 2.5%. And the mechanism for that is that they had unlimited bid in order to buy any treasuries that tried to go over that peg. And effectively, for the first few years, they had to do that a ton. They had to basically increase their treasury holdings tenfold in order to take all that supply off the market, just kind of monetize a huge chunk of debt. But eventually they kind of shifted around, and they had the commercial banking sector buying a lot of it. And so, right now, if you look at treasury holdings as a percentage of total U.S. bank assets, it's at a multi-decade high right now. They're basically very exposed to treasuries. And the last time they were this high was the 40s and 50s. So basically a lot of that war funding back then, the huge government debt to GDP, in addition to the Fed, a lot of it was funded by the U.S. commercial banking system. And so that's why I think that SLR rules changes, especially because Powell's been mentioning them as a possibility, I think are another lever to watch. So there's a handful of levers that they have. It's obviously impossible to predict for sure which levers they're going to use in which order. But I'd be on the lookout for ways for them to reliquify government debt markets without necessarily calling it QE.
I think in China, they lowered their reserve requirement ratio similar to what the U.S. did in 2008, 2009, down to zero or around zero. So the banks can theoretically have unlimited leverage ratios, but that's keeping the banks afloat so they don't look insolvent because of falling real estate prices. So all these governments are just changing the rules with their banking system. The average person out there who's listening to this, we're speaking about a lot of complicated banker terms. It's going to be very difficult. You just have to try to pay attention to the rules changes as best you can. And experts like Lyn are going to try to simplify things. But what we're saying now, it could be totally different a couple weeks from now or a couple months from now. That is how much the rules could potentially change going forward. They could change every couple months, unfortunately, going forward.
Yeah, there have been a number of rules changes to money markets and things like that over the years, mainly to get them to hold more treasuries. And then when it comes to U.S. banks, The main, historically, the key thing to watch, of course, is the capital ratio. So they're not really constrained by their reserves; they're constrained by capital. Basically, how much capital do they have relative to their asset base? And so, I think one of the key differences now is that banks are going to face some troubles in the years ahead, but it's not the same as they were in like 2007 because they have a larger percentage of their assets focused in kind of nominally risk-free assets. And so they're very exposed to inflation, but they're less exposed to credit risk than they were, say, 14 years ago, but they still are significantly exposed to credit risk. And so I think essentially what we're going to see is that the banking system is going to be serving kind of like utility for, the Federal Reserve, basically serving as a way to soak up treasuries.
So I want to transition now the remaining part of the interview to bear markets and maybe commodities, gold and silver. Get your thoughts on that before we wrap up. So are we in a prolonged bear market now, maybe a long-term bear market in your opinion? And what types of asset classes have historically done well in past bear markets?
I think to the extent that we have a bear market, it's in significant ways, it's depending on what happens with energy markets and it's what happens with monetary and fiscal policy. And so one thing I like to point out is if you look at emerging markets, when they go through stagflation or recessions, depending on how high the inflation is, I mean, you can have stock markets going up in local currency terms, even when, of course, they're doing very poorly if you look at them in dollar denominated terms. So they're really kind of the denominator is melting along with the numerator, not necessarily doing very well. And so it partially depends on how much inflation we get. But overall, I think that equity markets are going to be in for a very choppy environment in the broad sense going forward because their profit margins are going to be pressured. So the areas that I think I'm bullish on, one is that in stagflation environments, commodities generally do pretty well. But it's not a straight line. They're very volatile. I mean, if you were investing in commodities in the 70s, you obviously did very, very, very well. Commodities were their producers. But you would have pretty vicious pullbacks and counter rallies, kind of counter bear markets along the way. And so an investor really has to kind of know why they own what they own and be willing to just make sure they're risk managed and that that they understand the volatility that they can go through in these types of environments. Like we discussed earlier, they can temporarily crush oil prices potentially if they cause a severe enough recession, but then you could get a bounce back on the next, leg up in stimulus. And so an investor has to, look through that and not be shocked if something like that happens on a number of their commodity investments. Generally, in this type of declining PMI environment, so Purchasing Managers Index is kind of like a simple way to measure economic acceleration or deceleration. Usually when it's going down, as it is now, gold tends to do better than, say, copper, and tends to do better than broad equities. And so right now we've seen, for example, gold hold up surprisingly well despite the uptick in rates this year. I think it also got an added kicker because starting in February 2022, we basically gave a gigantic announcement to the world of why they should not own too many treasuries or euro bonds, and why instead they probably sovereigns should look back into the gold market if they want to have sovereign reserves that don't have counterparty risk. And so I think we're probably going to see a decent sovereign bid for gold over the next couple of years. And generally, when you see something that could be having a bearish environment, but is not, right? So the fact that gold is holding a well in the face of these rises in treasury rates, I think is very promising for that asset. And so I'm fairly bullish on precious metals. Risk adjusted, I like gold a lot, especially in this kind of declining economic environment. And so it's hard to say for sure what the dollar price is going to do over, say, a 6 to 12 month period. But I do think it's one of the places to have in a portfolio as something that is, I think it offers a lot compared to what other assets are offering when you have, basically Federal Reserve hiking policy into a deceleration. And then if you do get a Fed reversal of some sort, as we enter a deeper recession, gold would presumably be one of the ones to pop because right now, there's a lot of good things in gold favor. But there's also, the strengthening dollar and rising rates are putting some pressure on it. And if those pressures go away, then gold has a chance to really kind of pop up. And so my base case has been kind of looking for somewhat of a cup and handle pattern on the gold price, but I don't try to predict exact gold prices or exact timeframes, but I do expect to see higher gold, higher highs than we've seen recently. And actually, if you look over at gold in euros or yen, it's already doing quite well. And so I think in time that will show up more and more on the dollar chart as well, if I were to guess.